On Monday morning, March 10, 2008, Bear Stearns opened with roughly $18 billion in cash. By Thursday night, it had $2 billion. Nothing had defaulted. Its regulator insisted its capital exceeded every requirement, and 85 years of history was gone in about 72 hours. This was not a fringe operation. Bear Stearns was one of the 5 great independent investment banks, the second largest prime broker in America with 21% of the market, and fixed income drove 45% of its revenues. The biggest piece of it, a mortgage machine that packaged $36 billion of CDOs in 2006 alone. This is the autopsy of the first Wall Street run. Start with the geometry. Roughly $400 billion of assets stacked on about $11 billion of equity, leverage that reached about 38-to-1 by November 2007. And the most illiquid, mark-to-model holdings, the Level 3 book, stood at more than 2.5 times tangible common equity. By February 2008, mortgage-related Level 3 assets alone were $17.2 billion, more than the firm's entire equity. A write-down of a little over a third on that book, and the equity is gone. Now the fuse. Through 2007, Bear cut its unsecured commercial paper from over $20 billion to under $4 billion, and grew secured repo borrowing from $69 billion to $102 billion, on paper safer, because collateralized. In practice, the firm now had to reborrow $50 to $70 billion every single night in the tri-party repo market, and the clearing bank in the middle of that market, its daytime lender, holding and pricing its collateral daily, was JPMorgan. Remember that name. The first tremor came from inside. Bear Stearns Asset Management ran 2 hedge funds under Ralph Cioffi, the high-grade Structured Credit Strategies Fund and an enhanced leverage version. They held nominally AAA and AA rated CDO tranches, about $1.4 billion of investor money, levered up through repo. Not junk, rated paper. That is the more damning version of the story. In June 2007, the leverage bit. Redemptions were suspended on June 7th. Then Merrill Lynch seized roughly $800 million of the fund's CDO collateral and tried to auction it, and could only move about $100 million at markdown prices. A failed auction is public price discovery. Every dealer holding similar paper now had a real, low print threatening its own marks, and haircuts widened across the street. That is the first turn of the spiral. Bear pledged up to $3.2 billion to rescue the less levered fund, taking roughly $1.6 billion of subprime assets onto its own balance sheet to protect its name. It didn't work. By mid-July, the high-grade fund was down about 91%. The enhanced fund was essentially worthless, and on July 31st both filed for bankruptcy. Well over $1.5 billion of investor money gone. The funds were a fuse, not the detonation, but the damage compounded. Co-president Warren Spector was out in August. In December, Bear reported the first quarterly loss in its 85-year history, $854 million on a $1.9 billion mortgage write-down. Jimmy Kane gave up the CEO seat in January. And the smart money was already leaving. Prime brokerage client assets fell from $160 billion in January toward $90 billion by April. Renaissance Technologies pulled everything. Monday, March 10, 2008. Bear opens with about $18 billion of liquidity and a wire crosses the tape. Moody's downgrades securities issued by something called Bear Stearns Alte Trust, a securitization vehicle, not the firm. The headlines compress it to Moody's downgrades Bear Stearns. The rumor is wrong. It does not matter. Every repo line still rolls that day, but the phones have started ringing. Tuesday, March 11th. The Federal Reserve announces a $200 billion facility to lend treasuries against mortgage collateral, but it won't launch until March 27th, and the market reads the announcement itself as a signal. Someone is in trouble. That afternoon at 4:06 p.m., Goldman Sachs emails a hedge fund refusing a routine novation, declining to step in and face bear on a $5 million position. Goldman relents the next morning. Too late. On a trading floor, hesitation is information, and by then it was all over the street. The same day, press reports later documented, someone paid roughly $1.7 million for deep out-of-the-money puts strikes at $30 and $25, expiring in 9 days with the stock near 65. The SEC opened an investigation and issued more than 50 subpoenas. No charges were ever brought and the buyer was never identified. Hold that thought, because whoever it was, they didn't kill bear. The equity tape was the scoreboard. Repo was the game. Wednesday, March 12th. CEO Alan Schwartz goes on CNBC. Quote, "We don't see any pressure on our liquidity, let alone a liquidity crisis." That same day, Bear pays $1.1 billion in margin calls to 142 derivatives counterparties, and the pool is down to about $12.5 billion. After the close, 2 of its biggest cash lenders quietly warn they may hesitate to roll $1 to $2 billion of repo. Thursday, March 13th. The cliff. $14 billion of repo will not roll, and some lenders refuse to lend even against Treasury collateral. The run has stopped discriminating between Bear's assets and Bear itself. By nightfall, the liquidity pool is $2 billion, and Bear tells its regulator it cannot operate normally on Friday. Schwartz phones Jamie Dimon and asks for a $30 billion credit line. Dimon says no. Understand why this is the perfect run. A repo lender doesn't need to believe you're insolvent to kill you. They only need to decline to relend for 24 hours, and declining costs them nothing, because they're holding your collateral. Secured lenders run fastest precisely because they're secured. No negotiation, no workout, no reason to stay. Bear had rebuilt the deposit run of 1930 out of institutions and wire transfers, a bank in economics, with no deposit insurance and no discount window in law. And here is the coldest fact in the file. The SEC maintained all week that Bear's capital exceeded requirements. In its chairman's words, a lack of confidence, not a lack of capital. Solvent on its marks, while the run invalidated the marks. $16 billion of cash left the building in 4 days. Friday, March 14th. Before the open, the New York Fed invokes Section 13(3) of the Federal Reserve Act, emergency lending reaching a non-bank for the first time since the Great Depression. $12.9 billion, routed through JPMorgan, secured by $13.8 billion of collateral. It buys exactly one thing: a weekend. The stock falls 47% anyway, closing near $30, and S&P cuts the firm 3 notches. Friday evening, Treasury and the New York Fed deliver the real message. The loan will not be there Monday. Find a buyer before Asian markets open Sunday night. Only one bidder could credibly diligence a $400 billion balance sheet in 48 hours. JPMorgan, Bear's own clearing bank, which had been holding and pricing Bear's collateral every single day for years. The daytime lender became the buyer of the corpse. Sunday, March 16th. $2 a share, about $236 million for the whole firm, less than the estimated value of its own Madison Avenue headquarters. Bear's board minutes record that JPMorgan had considered $4 and cut it to $2 because, quote, the government would not permit a higher number. Moral hazard had a price, and Washington set it. That same day, the Fed opened an overnight lending window for investment banks, the exact facility that, 5 days earlier, might have saved Bear Stearns. Then the lawyers found the hole. The merger agreement, drafted in a sleepless weekend, arguably left JPMorgan guaranteeing bears trades for up to a year, even if shareholders voted the deal down, a free option to hold out. On March 24th, the price went to $10 a share, roughly $1.2 billion total, and JPMorgan bought 95 million newly issued bear shares, 39.5% of the company, locking the vote before shareholders ever cast it. They approved in May. Of course they did. The ledger. Joe Louis, the billionaire who bought the dip starting in September 2007, lost roughly $1 billion. Jimmy Caine's stake, worth about $1 billion at the peak, sold for around $61 million, down 94%. 14,000 employees who owned roughly a third of the stock watched a culture of savings vaporize. And the top 5 executives had already extracted more than $1.4 billion in cash and stock sales between 2000 and 2008, more than the SEC's entire annual budget. Accountability came for exactly 2 men, and it missed. Fund managers Ralph Cioffi and Matthew Tannin were indicted in June 2008, the only criminal trial of Wall Street executives to come from this opening act of the crisis, and a jury acquitted them on all counts in November 2009. They later settled the SEC's civil case for just over $1 million combined, admitting nothing. No senior bear executive was ever charged. And the $30 billion bailout. Read the structure. The Fed didn't buy bears' toxic assets. It made a collateralized loan through a vehicle called Maiden Lane, $28.82 billion senior from the New York Fed, $1.15 billion subordinated from JPMorgan, with JPMorgan in the first loss position. The senior loan was repaid in full with interest by June 2012, and by the final sales the public came out roughly $2.5 billion ahead. Bears' shareholders were not rescued, the creditors were, the system was. The reforms trace straight back to this week. Within 6 months, the standalone investment bank was extinct. Lehman died in September with no buyer and no Maiden Lane, and Goldman and Morgan Stanley fled into bank holding companies. Dodd-Frank later rewrote the Fed's emergency lending power, so it can never again rescue a single firm. Tri-party repo was replumbed to kill the daytime lender exposure. And 30-day liquidity rules now exist because an $18 billion pool vanished in 4 days. So file the cause of death precisely. Bear Stearns was not murdered by short sellers, and it did not die of insolvency on paper. It died because it funded a $400 billion balance sheet with money that expired every morning, and once the collateral became unpriceable, not rolling became the rational trade for every lender at the same time. The write-downs didn't kill Bear. The write-downs just told the lenders where to aim. On overnight money, every day is a referendum. You only get to lose one.